Chapter 4, Part 2, Cash Flow using the Indirect method, which just so happens to be my favorite method. Okay, again, format of the statement of cash flow. For operating activities, you have the choice between using the direct, which I cover in a different part, and the indirect method for this section of the cash flow statement, which is what I'm covering now. You always get the same results. Then we separate out investing activities, buying and selling long-term assets, and then financing activity, buying and selling stocks, issuing bonds, buying other people's stock, issuing dividends. This all goes there. All right. Again, if we use the direct method, it reports the cash effects of each operating activity. Indirect, we take accrual net income and we're going to convert it to cash. Now, here is our trial balance that we're going to work with, and what we're trying to do whenever you're doing a cash flow statement is you're trying to explain the difference between the beginning of the year and the ending year cash. Also, if you have accounts receivable, always try to combine it and it's called net accounts receivable. We also, to do a cash flow statement, we need the income statement. Also, we'd need some additional information, like for instance, they said equipment that would cost $10,000 was sold and it was 60% depreciated, which means we're going to have to adjust the equipment account as well as the accumulated depreciation account, because we know when we sell equipment, we have to adjust both those accounts. Cash dividends were declared and paid, but it doesn't tell us how much. Common stock was issued for the land, so the change in the land account would be part of any sale of stock. And a debit investment of $35,000 was sold, and there was no write-off of collectibles this year. So, step one. First thing you want to do, if the problem hasn't done it for you already, is to subtract the current year from the prior year to get the change. And you have to explain every single one of those changes as we go through and do our cash flow statement. Now, first, what our total should be in the end for operating, investing, and financing activities has to equal $19,000. So that's our check figure right there. Now, cash flow, indirect method. The first thing we need to do is determine what part of the cash flow statement items belong in. So, what you would do is you would go through and categorize them. So, first thing I would do is I would say, okay, which of these would go into investing activities? That would be accounts receivable, all current changes in current assets and current liabilities. Inventory, allowance for doubtfuls, accumulated depreciation, and accounts payable, along with income tax payable. These would all be part of our operating, and these are the ones we have to include as part of operating activities. Next, we're going to look at what's part of investing activities. Investments, equipment, land, except that, well, we'll talk about that in a minute. Long-term notes and stock. Now, the land is a non-cash item because we've already, in the beginning, said that we gave stock in exchange for the land. So that's a non-cash transaction. Also, retained earnings, we have to remember, is part of operating and finance because retained earnings includes payment of dividends and net income. Now we can start our process. Now what I always like to do, in this case I'm going to have to determine what was my depreciation expense, because it wasn't spelt out for me in the problem. So what I always do is T accounts. I start with the accumulated depreciation for each one. In this case, I put them in separate accounts. I know the beginning balance and I know the ending balance. I also know I sold a piece of equipment, and we know that we must take out accumulated depreciation if we sell a piece of equipment. So that means we're going to have to debit that. Now, what we need to do is figure out what number we need to put in there to make it equal. So 14,000 minus 6 plus some number equals 21,000. So our depreciation expense would be 13,000 there. And for building, it would be 28 minus the 37 would be 9. So we have a total of $22,000 for depreciation expense. Okay. So that's going to be on our cash flow operating activities as something we add back in, because remember, depreciation expense is a non-cash transaction, so we add it back into net income to get to cash-based net income. So here's what we're going to do. We're going to start with net income. We're going to add back in the depreciation expense. We're going to subtract out any gains, because we realize that gains are just an adjustment when we sell a piece of equipment, and the actual cash is what we receive for it, and that would be under investing activities. And the same with the loss. We have to add that one back in. We subtract out the gain. We add back the loss. Now, here's the rule. Changes in current assets has an inverse relationship to cash. So therefore, if accounts receivable goes up, which means we had sales we didn't collect on, we're going to subtract it from cash. For liabilities, they go in the same direction. If accounts payable goes up, we subtract it. It increases cash, because what that means is we have an expense that we didn't pay. So our accounts receivable went up, we got to take it out, and that was the net amount. Our inventory went up, we got to take that out. Our accounts payable went up, we have to add that back in. And our income taxes increased, we have to add that back in. And so now we have net cash flow from operating activities of $48,000. Now again, the total would be the same regardless if we're using the direct or indirect method. Now we're going to look at investing activities. We have two items. We have the investments and equipment. And what I like to do is cross things out as I use them. Okay. And that tells me what I still have to account for. All right, so now for investments, we know the beginning and ending balance, but we also know we sold something. So what number do we have to come up with for what we spent on investments? And the answer is $5,000, because that's what you need. So if you take 85 plus 5 minus 35 gives you 55. Always check. Now what about cash generated from investments? What would be the journal entry at the point of sale? Well, we don't know how much cash, but we know we had a gain on sale of 15. We know the investment was valued at 35, so that must mean that our cash was 50. That's how much cash was generated. Now, what about equipment? We know we sold 10. So it also means that we must have bought $32,000 worth of equipment, because if we take 48 minus the 10 we sold plus 32,000, we get an ending balance of 70. Now what about cash generated from equipment? Again, I like to recreate my journal entries unless they tell you how much cash was generated. So in this case, the journal, we had a loss on sale, which would have been a debit. We had accumulated depreciation of 6. We had equipment of 10, which means we had cash of 1,000. Now we can do our cash flow from investing activities. So we take the 5 and the 32 that we spent on investments in equipment. We're going to add back in the 50 that we got from the sale of our investment and the sale of the equipment. So we have positive cash flow of $14,000 from investing activities. Now we go back to our trial balance, and what we have to remember when we're looking at the common stock, that $15,000 of that was used to buy land. So the actual cash when we issued that stock that we received is the difference, or $35,000. And again, we cross those off. So, retained earnings. We started with 95. We had 67,000 in net income. And we had an ending balance of 92. How much did we pay in dividends? Be 70,000. And if you take 95 plus 67 minus 70, you'll get 92. Now, cash flow, financing activities. We paid the long-term note of 8,000. We had cash dividends of 70, and we got 35,000 for selling our stock. So we had negative cash flow of 43 from financing activities. Now we're ready to do our whole cash flow statement. And here is what we look like. We would have taken our net cash flow from operating activities. Then we would have had cash flow from investing activities, and then we would have the outflow from financing activities, and that would give us our total change in cash. We would add our beginning balance to get 70. Now, here's what you would do with this cash flow statement if you're an investor. You would be happy with what you saw, because from what we could see, that most of their cash they generated was from operating activities, which is where you want the cash to come from. And cash flow from investing activities was because they made some smart investments, but then they turn around and bought equipment. And the cash flow from financing activities, the outflow was based on paying dividends. So this, I think, would be a happy financial statement. And that ends this presentation.